Well, hello everybody. This is Ken Winans and Stephanie Larson from Winans Investments, and apologize for my hoarse voice. I'm sure many of you out there have been also fighting the wintertime cold and all that. So, Steph and I just want to give you a brief video about what's been going on. I know that for a lot of us, this is beginning to feel like a kind of a deja vu of 2007, 8, and 9 all over again. But let's talk a bit about what's going on in the market right now, and then also just to assure you that clearly we're here dealing with it, and certainly we'll focus on it. So let me jump in with a big one. First off, as far as we know, we have no exposure to Silicon Valley Bank, Signature Bank, or I think we have one small position in Credit Suisse, which is actually holding up well. So just so you all know that we typically do not jump into financial companies. I've always had hesitations about it, mainly because of maybe it's the ghost of the past being what happened in 2008 and 9, and my very strong suspicion about ratings in general. But with that being said, it has caused volatility in the stock market, as you all know. At this point, between the Federal Reserve continuing to raise rates, and I do think they will continue to raise rates. The Federal Reserve's job is not to save banks, it's to keep inflation under control and to have full employment. That's their only mandate. So I do think they'll stay on course for that. However, one of the things that we should consider is that credit itself could actually be contracting. With what's happening with these banks and the convulsions of these banks, you might find that credit is just not as available, especially for commercial credit, as it has been in the past. Again, that's all part of what goes on in these kind of situations. Steph, you want to add anything?
Yeah, I mean, we've definitely had a lot more calls lately, concerned clients that have deposits at First Republic or things like that. I assure people that, TD and Schwab, which is our custodians, are not these banks. They obviously, they were not bailed out in 2008 and 9, which is another thing that we really appreciate about them. I just feel that, it's a little bit of a shock to the system. The Credit Suisse one, I have friends still in London, which is where I went to school, and they've actually been mitigating their exposure to Credit Suisse for years. They've been slowly pulling away from them. It's kind of been a known entity that they were a little bit too extended and a little bit of trouble. First Republic, I personally know a lot of people there and actually worked for them for a little bit. It's a great bank. I'm a little surprised, to be honest, that they're coming under such pressure. And obviously, for those who don't know, who haven't come to our office, we actually work in what's called Pell Plaza, but it's the headquarters for Bank of Marin, which is a regional bank. And, speaking with some of our friends in the building, they're fine. I mean, everyone's worried about deposits because one of the things that this situation causes is a run on deposits. People get concerned and either maybe take their money out or, which is very common, hypothetically, say Ken had $1 million at, the bank for whatever reason. That's his little piggy bank that he feels comfortable having it at, not invested in the market.
I wish.
You know what I mean? But say hypothetically he did, well, look what's happening in the market. That you could get much higher yield by investing into bonds or preferreds and things like that. So he's looking at inflation going, well, I'm losing 8% a year if I just leave my money here, or I can invest it over here and at least keep up with inflation. Well, the bank isn't a custodian. We can't have our clients' money with them. So the natural cycle of things of inflation causing investors to seek more yield is pulling cash away from the banks, which is actually compounding the problem. So it's like Ken said, it's one of those cycles that we're kind of stuck in. When you have a confluence of them, that's when you tend to get into some problems. But I don't think there's going to be a contagion effect. I did work at a major bank actually after 08, 09, and I remember sitting in all those transaction meetings when they were approving credits and lines and talking about covenants, and 08, 09 was really scary, and a lot of the regulations that came down were strict, and the shareholders are very aware of it. So, in talking with one of our friends, one of the things they're talking about, well, earnings are going to start coming out again next month. We're almost at April. And that's going to be the telltale signal, like How does liquidity look? What do the deposits look like? You can have a run on your stock price, but that doesn't mean that the financial security of the company is necessarily in trouble. So I think for us, we have very little exposure in our portfolios to them. We have a couple preferreds that are in banks. Morgan Stanley is one of them, and things like that, but not a lot. We're not concerned about where we are, but I want to see the numbers. I really want to be like, I want to look under the hood and see, okay, so what really happened this last quarter? And that's going to be pretty telltale to see what happens.
Well, the old adage of keeping your powder dry, as many of you know and have commented, we have kept a fairly large amount of money in the accounts by design. I really did not think the January rally was the beginning of a new bull market. I wish I'd been wrong. It'd been nice if that had happened, but as we're finding, it's going to be a very volatile, choppy year. But let's talk about some things in the portfolios that are good. Bond prices have largely bounced back from the lows of last year. They're nowhere near the November lows. And as we told you in one of our previous videos, that when people are seeking yield, and you can find corporate bonds in non-financial companies, mind you, that have brick and mortar or basic business structures where it's easy enough to track what's going on in their debt and their revenues, and it's not as opaque as it is with financial companies, that they're fine and that they're continuing to move ahead, and the yields are compelling and people are moving there. And many of you have talked to us about changing allocations. But let's also realize too that even within the stock market, there are clearly some companies that have held it very well. Ironically, one that's a financial company that many of you have, and I don't generally talk about individual names, but I'm bringing this up as an example, Progressive Insurance. You look at its stock, it doesn't look like anything bad has happened to the world in the last 3 years. So again, there are individual companies that are well run and have navigated the inflation world and the volatility world. But I will just, one other quick thing I'd pair Stephanie on. I find it easy to bring things down to the simplest common denominator. When I read about financial companies getting in trouble, it's always the same stuff. And it's also when I go back in history and look at what's happened. It is over leverage, illiquidity, and very faulty assumptions on risk. Whether it is believing that real estate never loses value, whether it is believing that it's okay for banks to make investments into tech companies with their own capital. I mean, again, I think there's a lot of things that go into this, and you find that and I dare say it's just blatant stupidity most of the time, and it seems to be contagious. If one person does it, the other people typically do it too. Okay, so where are we on things? We will continue to be active in managing our portfolios. We will continue to trim positions back in stocks that are not doing well. We will continue to use hedges, which, remember, for those of you who might not be familiar, it's meant to be a counterbalance in your portfolio. These types of vehicles go up in value when the market goes down, so it lightens the volatility in the portfolios. I am not, certainly will not be hesitant on having cash sit in short-term money market instruments, or even look at treasury bills as a place to get a little extra yield as we play out the year. Certainly, Stephanie and I are leaning toward buying more income-oriented things as we go out the year, meaning that in all of our portfolios, you have all given us the ability to have a 10% variance, meaning that if you have a 50-50 portfolio, we can actually move things out to 60-40, meaning 60% income, 40% growth, without having to change your contracts. That's to take advantage of situations. So go ahead.
I agree. No, Ken and I have been talking about the cash management. That's something we're really approaching this year really holistically with the portfolios, reviewing our exposures, really rotating. You've seen probably quite a bit of trading the last few weeks. A few weeks ago, I was really loading up on preferreds. They're cheap. I want to buy them. They're going to still give you your dividends. We're rotating through our stocks if we're not liking them. I have almost everybody, unless you've given us new money or changed your allocation, or you're a brand new account. I have almost everybody fully invested on the income side. I want to make sure we squeeze every dollar out of that interest that we can get from those bonds. And Ken's right, we're probably going to lean in a little to the bond side a bit more. We just want to make sure that we really maximize what we can with the portfolios, and then when we see the daylight in the clouds on the equity side, I mean, we have no problems being aggressive on that. And actually, some of the new names we bought actually are doing really well. Few that we're watching on our watch list, but I like the positioning that we're making. We're trying to be really thematic, careful, strategic with the way that we approach the portfolios this year, because it's going to be a complicated year.
Let's talk some positives. I know now you're all probably very depressed, and let's talk about where we go from here. Again, we can go back and look at it historically, or even just in my own experience, what happens. At some point in time, the Federal Reserve is going to say, we're done. We're done for now. Mm-hmm. It doesn't necessarily mean they're going to lower rates, but it means they're not going to continue to raise rates. When that happens, and I saw this happen in certainly early in my career in the early 80s, I saw the same thing happen in the mid-90s. When those magic words come out, that Fed policy has now become neutral. Mm-hmm. What's going to happen is you will find bond prices will take off, because suddenly people are realizing that the bond yields are as high as they're going to go. At that point in time, our strategy would be is to extend maturities in our bond portfolios. Right now, they're running at 2.5, 3, 4 years. You'd want it to go out to 6, maybe 7 years on average. Mm-hmm. And on the equity side, you will suddenly see the equity markets suddenly percolating and get very positive, and you'll see momentum begin to build. Mm-hmm. So here's my point. Keep your powder dry, let situations develop. If I have to guess on Fed strategy, and everybody's doing it right now, I truly believe it's probably going to be in the later half of this year, more than likely going into the fall. Mm-hmm. There's a cyclicality to money flows in the United States. Mm-hmm. September always seems to be an interesting time of the year where the Federal Reserve, the Treasury Department, they're all doing these kind of interesting things to try to finish out the budgets for the year. Also, municipalities do as well. So if I have to stare at my tea leaves and try to figure out what the Fed's going to do, I would gear that the fall will probably be the beginning of some new upsurge. But again, for those of you who are scared, just realize we're playing defense. We're not here to, as you all know from last year, we minimize our losses as best that we can. And we just want you to know that although our voices might be hoarse right now.
We both were sick, but not from each other.
Yeah, absolutely not.
My kids got me sick. He got sick traveling.
Yeah, I was in Vegas and got sick there. So anyway, just you all know that we're here. What I would encourage is this. Let's get past tax season before you make any knee-jerk changes to your portfolio. Let's get past tax season, which is, we're going to put out first quarter reports here in the not distant future. And if any of you do want to make changes to your portfolio, let's look at the later part of April to do those things going into the fall.
We also strongly encourage a group discussion with your CPA. We have several clients that have done this with us. We believe in a holistic strategy with your finances. Let us work with your CPA. Let's see how we can all help your situation. If anyone comes under a larger than expected tax burden, let us know, because we also have strategies for how to take care of that with mitigating the effect to you financially. I mean, you're going to still pay for it, but there's other ways that we can handle it where it doesn't really hit the pocketbook right away. So we also strongly encouraged our clients to talk to us about that too.
Absolutely. Yeah. I've done a fair amount of travel in the last, just seeing clients and things. I was in Las Vegas, I was in Southern California not long ago. And what I would say is this. The economy is still, we're in this post-COVID malaise. I guess probably might be a good word for it. It's an old line term. But it's just that the gears are not quite in full alignment. Things are still not efficient and effective, whether it's at a restaurant, a hotel, wherever you may go. I think in time we will figure out how to get the gears meshing again, but it just takes time. So again, I know we all are hoping that we go back to the post or the pre-COVID world. That's not in the foreseeable future. However, there is a way to make money and to get through this environment. One final thing, let me talk about commodities. Yes, oil prices have backed up quite a bit because of the concern about the economy. Mm-hmm. I would just caution everybody, commodities are always by their nature very cyclical. Mm-hmm. And oil rarely does well in the wintertime. It's just the nature of it. Mm-hmm. I think the real test for any of the commodity plays is going to be going into the spring season, into the summer. So before we all think that commodities are gone and they're not going to improve, and I talk about commodity stocks, just be cautionary on that. It never pays to sell them on a downdraft. and not be prepared to
gold.
reinvest. Oh, and gold.
Gold.
Many of you will notice that we did increase our exposure to gold through the ETF in the portfolio. Again, gold is holding up very well this year.
It's actually taken off a little bit lately.
It has taken off. Yeah, I think with the concern, what's going on there, I've actually had some people who did experiment with crypto before who have said, I'm not going to do that again, but I'm more inclined to want to do gold this round. So I think there's real legitimate demand for it.
Yeah. So I think the moral of the story here, we are on top of it. It's going to be a really interesting, I'd say, next 4 weeks, 6 weeks. You know, part of what's happening is with the Fed. The Fed's making a lot of decisions. Everyone's paying attention to Powell and what he's talking about. He still has good, strong, job report data, which we keep seeing. Everyone's surprised every time that it comes out. I'm not surprised. But then at the same time, we see major layoffs with some massive companies. They're trying to get ahead of their financial book, right? Or they're trying to stabilize everything. So when you see the headlines of Meta's laying people off and, et cetera, et cetera, et cetera, it really concerns people, but it's really centered around certain companies or certain industries. Tech's getting picked on. That's not uncommon. Obviously, living not too far from Silicon Valley, we're very aware of that. And at the same time, everything going on with the banks. So I think the Fed is probably going to slow down, still raise rates, but slow down. They're very aware that the needle that they were threading that was really thin just got even thinner. So I think they're going to be careful. We're going to be aware of it. And at the same time, it's going to be a very interesting earnings season from retail to tech to the banks. So everyone's going to be paying attention to what's going on. At the same time, everyone in the market is kind of holding their breath, because the one thing that investors don't like, whether it's investors with their companies or in the stock market or with bonds, the one thing everybody hates is uncertainty. So the thing that we're looking for is to find a little stability in everything and have the surprises go away. And then I think you're really going to see the market level off, which I think would be great, and take off, hopefully. So it's going to be an interesting few weeks here coming up, maybe 2 months tops.
Yeah, I agree. And then just also, as bad as we might be concerned about things here, things going on around the world are actually much worse. We actually have some people from Europe who have been talking with us about how to get money to the United States. So, we are still, even with all of our troubles and our perception of what's going on and with our elected leadership, again, it could be much, much worse. So, folks, we're going to end it right there. Just want you to know that we are here. We're not running for the hills. We're not overly concerned. It's just part of the adjustments that we all have to get used to. We hope to see all of you sometime this year. We are still planning on having an investment conference probably in mid-June as it sits right now. There will be more details to follow on that. And I just hope you and your family are doing well, and we'll take it from there. So good seeing you all. Take care.
Thanks, guys.
Bye-bye.